Have you ever wondered what it really means to own stock? Well, in the next few minutes, we're going to break it all down, how you can own a piece of a company you love in a super simple and fun way. Let's dive in.
I mean, think about the phone in your hand, or that coffee you grab every single morning. What if you could own a tiny slice of the companies that make those things? Well, guess what? You can. And that's exactly what owning stocks is all about. See, at its core, a stock isn't just some number flashing on a screen. It's a share of ownership in an actual, real-life business. The easiest way to think about it is like a giant pizza. When you buy a share of stock, you're buying one slice. And hey, as a part owner, you get to share in the company's success, and of course, its profits.
All right, so you've decided you want a slice of that pizza. But what kind of slice are we talking about? Just like toppings, stocks come in two main flavors, common and preferred. And knowing the difference is pretty much the first step for any investor.
Okay, so here's the deal. It all comes down to a trade-off. With common stock, you get voting rights. You actually get a say in how the company is run. Pretty cool, right? You're in on the action. But your share of the profits, which we call dividends, isn't guaranteed. Now, preferred stock is different. You usually give up your vote, but in return, you get a fixed, predictable dividend that gets paid out before common stockholders see a single penny.
And that brings us to the biggest difference, risk. If a company were to go bankrupt, common shareholders are at the very back of the line to get their money back. So what's the big takeaway here? Common stock gives you that shot at huge growth potential, but yeah, it also comes with much higher risk.
Of course not. Not even close. Just like you can get a personal pizza or one of those giant party-sized ones, companies come in all different sizes. And that is the next big way we categorize stocks.
So, how do we measure a company's size? We use something called market capitalization, or just market cap for short. I know it sounds a little complicated, but it's actually super simple. It's just the total value of all of a company's shares added together. That's it.
Companies usually fall into one of three buckets. First, you've got your large caps. These are the titans, the absolute giants of the industry, worth over $10 billion. Think Apple or Microsoft. Then there are the mid caps, valued between 2 and 10 million, which are often in a sweet spot of growth and stability. And finally, you have the small caps, worth under 2 billion. These are often the exciting up-and-comers with tons of growth potential, but you guessed it, they also come with the most risk.
So beyond the type of stock and the size of the company, there's one more important layer to think about, your investing style. This is all about the why, the philosophy behind why you're buying a certain stock. The two big styles you'll hear about are growth and value.
Growth investing is all about the future. You're looking for those rocket ships, companies that are expected to expand way faster than everyone else. People buy these stocks hoping the price will just soar as the company takes off. And these companies, they often don't pay dividends because they're pouring every penny right back into the business to fuel that explosive growth.
Value investing, on the other hand, is kind of like bargain hunting. With value stocks, you're searching for hidden gems, companies that, for whatever reason, seem to be trading for less than what they're truly worth. These are often solid, stable companies that might just be a little overlooked by the market right now. The idea is that, eventually, everyone else will catch on and the price will go up.
Now, beyond these main categories, the stock universe is just huge. It's incredibly diverse. So let's do a super quick lightning round of a few other common types of stocks you're definitely going to hear about.
Seriously, there's a stock for just about any strategy. Looking for rock-solid stability? Blue-chip stocks are those established industry leaders. Want a regular paycheck from your investments? Dividend stocks are designed to do just that. Some stocks, called cyclical, ride the waves of the economy, while defensive stocks, like utility companies, tend to stay steady no matter what. You can even invest based on your values with ESG stocks, which focus on environmental and social factors.
Whoa, okay, that was a ton of information, right? So, what do you actually do with all of it? Well, the most important part is figuring out how to connect all this knowledge to your own personal journey as an investor.
So, how do you build a strategy that's right for you? It's pretty simple, actually. Just start by asking yourself 4 key questions. 1. What are my goals? Saving for retirement in 30 years is a marathon. Saving for a down payment next year is a sprint. 2. How much risk can I stomach? How much market turbulence can you handle without losing sleep? 3. What's my timeline? When you need this money? And finally, number 4, always remember to diversify. You never want to put all your eggs in one basket. A healthy mix is always the key.
And that really is the whole secret. Investing isn't about finding the one single best stock, because it doesn't exist.
It's about understanding all these different building blocks so that you can build a portfolio that's perfectly tailored to your goals, your comfort level, and your life. So I'll leave you with this question. Now that you know the lingo, what kind of owner will you be? Are you a growth investor hunting for that next big thing? A value investor looking for those hidden gems? Or maybe you want the stability of some blue chip stocks? Now you have the tools to start figuring that out.